Good evening. This is Doc Severson for the TheoTrade report for Tuesday, March 28th. I'll start out tonight's report on the S&P 500 cash index, and so far what we're seeing is this move is playing out precisely according to what this market needs. Now, what do I mean by that? Well, we can see that as the rally has come off of the election, we've gotten down to some truly historic exhaustion levels, and I've been pointing these out quite a bit lately, that on the monthly chart here on the left side, whenever we've seen a level of linearity to a rally which reaches this level, before long, it's not instantaneous, but before long we will see the market pull into a deeper range. Okay, so even if it's only for a month or so that we actually see some distribution, it's enough to count and allow this market to heal a little bit. Now, it may take more than just 1 month, but more extended sideways, but at least we've got a start so far. And again, not only the monthly chart, but also the weekly chart as well. Normally when we see two parent time frames in total exhaustion like this, we will see a more extended level of consolidation. Now, I am looking for the initial level of this to go down perhaps as low as 2,300. So far, it's not quite hit that yet, but let's give it time because we need to give it a little bit of sense of what's going on here. Now, if you read all of the punditry that's on out there, everybody's going to be talking about, hey, big recovery today. And a lot of that was driven by a very, very strong consumer confidence report, which is good, but that's also not necessarily good in that back in 2000, that pretty much printed the top for the market at the time. So I don't like to get into the business of trying to predict the future. What I like to do is instead let the chart do the talking. And right now the price is telling us precisely what's going on. So right now in the price we have, after all the good news has been faded lately. So all the good news has been faded like this. Every time we've had a decent green candle to the upside, whether or not it's a State of the Union address or whether it's Janet Yellen stepping up and basically giving certainty to the market through the FOMC at this point here, these are just creating a series of lower highs. So far, this is just a lower high. Now, how I'm going to evaluate this is to look at this based on a range. So what I'd like to do is I'd like to box this in. Now, the way that I box this in is basically look at the most recent high. So this is the most recent significant high, and here's the significant low. So right now we have pretty much a 70-point range from about 2320 up to about 2390. So that represents the most significant high. This represents the significant low. Now, some other folks have come along and said, whoa, it survived the test of the 50-day moving average. Who cares? Moving averages are just moving averages, and it's great to look at them in hindsight and say, yep, that 50-day moving average supported things. But ultimately, I think the market will choose as to where it's going to be supported, and it's probably not going to just be a moving average. So the obvious question at this point is going to be, well, Doc, how would I know whether or not this is reversing or not? Well, working through the box here, one of two things is going to happen. Either we're going to roll over and end up printing new lows, perhaps even going outside of this box down below here, okay? And that would just continue the pattern with a series of lower highs, lower lows. We're still in a downtrend. Eventually, we're going to be hitting a lower point here more than likely. And again, think about this. Even 2,300 is only a 4% haircut. That is not that much. Okay, so it would be great for the market to do something like this to be able to hit the reset button and kind of clear this froth out of the market. So that's the first possibility, is that the market goes a little bit higher here and then sells into this once again, creates another lower low. The other possibility that we have is that the market continues to rally here, punches out the high here, and then completes a reversal by printing a higher low. Now, what this will also look like here is, if you look at this correctly, this will be an inverted head and shoulders pattern, which is going to be bullish, okay? Without a whole tremendous amount of upside potential, though, I would note that. So again, in summary here, what we're looking for is a deeper range. Why am I looking for a deeper range? Well, because every time that we've seen this level of exhaustion, we have seen some kind of major range show up on the S&P, right? Every time we've seen this level of exhaustion, we've seen a major range set up on the S&P, okay? So far, 70 points does not really qualify for a major range. I think we may go a little deeper than this, at least initially. Now, market can do whatever it wants to do. It can rally up to new highs for all I care. What's important here is that you not come into any particular day with a notion about what you expect to see happen. That will be guaranteed to get you in trouble with this market. We've already seen it occur several times in just the last couple of weeks, because what looks like it's heading higher all of a sudden gets the trap door opened on it. What looks like it's heading lower, like yesterday, has seen a rally come right back up in people's faces. And so this is where it's important to frame things in and understand how you will handle this going forward from here. So in other words, if the market ends up going higher, how will you handle that from here? Write it down right now. If the market ends up printing another lower high and then another lower low, how will you handle that going forward? Write it down. Give yourself instructions on how you will handle this. And that will lead to a lot less of being whipsawed around based on your projection, based on some article that was written a day or two ago by somebody that's just trying to fill space. Now, the last thing I want to call your attention to is the volatility indices here. So the VIX futures. And if you'll notice, before every major reaction over the last couple of years, and we have had a couple of what I would consider to be modest reactions over the last couple of years, you know, enough to get your attention, enough to generate a little bit of interest in the market again. What you'll notice is every time we do actually have a reaction, it sort of works into that reaction, right? It works into that reaction before we finally have it. Here's a good example of this one into early 2016. Started to see some initial movements. Those grew, and eventually we did get the actual movement. You can also see this through the Brexit move last June. Some initial moves, and then finally the big reaction. So it's not like somebody didn't know something was coming in each of the situations. And as you can see over here on the absolute right side, we have come from utter complacency, and we're starting to see the very beginning formation of that eventual reaction. Okay, so I think we're very, very early into the initial move of this thing, as according to the VIX futures, that somebody knows that something's going on. So watch for this to start printing some very subtly higher highs and higher lows, and that will eventually trigger what normally creates kind of the waterfall decline that marks the end of this particular reaction in the market. So net, the market's in a range and will stay in that range until further notice. That's it for tonight's report. Thanks for listening. See you tomorrow.